But I'm joined now by my guest, who is a development economist in the person of Professor Ken Ife. Thank you, Prof, for coming on the program today.
Thank you for having me.
Prof, let us begin by, getting your overall assessment of the CBN's decision from the conclusion of the recent monetary policy meeting. An increase, most economic watchers, saw that as a surprise. That came to them as a shock. But let us hear from you. Did you see that coming?
Oh, yeah, definitely. I know that there are mixed feelings in various communities. First of all, the consumers, the ordinary people, are not even sure what has happened. The businesses will be crying out because when they look at the cost of borrowing, it's going up, so they will cry out. And then the commentators that you have just shown are all in the negative territory. Then the other community of economists and development economists were actually had mixed, some think it will hold, some think it might go. So there was that balance. But unfortunately, even last week when I was interviewed and asked to project, I said that the worst case scenario is that they will hold. But honestly, I think they will have to rise. And the reason is this: you cannot compare Nigeria to all these countries that you've mentioned. America has been holding for over 3 years, increasing their rates for over 3 years, and only just now began to reduce. The thing is that none of these countries has actually seen half of the structural factors Nigeria is facing. We have insecurity, which is very pervasive in all 6 geopolitical zones, different kinds of insecurity. We have high cost of fuel, not only PMS, but also of diesel, and it is rising. You have very high cost of power. It is also rising, over 100% increase. Then you come down to all other factors of production. You have road transport deteriorated so badly to even carry anything anywhere. For me, the transport cost has more than doubled in many cases. So all the input costs that are coming to manufacturers are high. So you now have cost push inflation on one hand. Of course, there's importation of things, high forex rates, and then it's talking of knock-on effect on imports. All of them are high. And then that, as I said, is cost push. But there's also demand pool, domestic demand pool. That's the one that is uppermost in the mind of the CBN. Because I tell you why. Inflation is the biggest single item in all the macroeconomic indicators that drives tens of millions of people into abject poverty instantly. And incidentally, it is the core mandate of an organization called central bank. So the buck stops with central bank on inflation. And the tools that central bank has are severely limited because they are all tools in the monetary policy area. They are not tools in the fiscal space. The fiscal policy people we shall come to. But so the bank uses its tools to restrict liquidity because liquidity is so high. How can your GDP be growing between 1 and 2%, even now up to 3%? But the liquidity was growing with about 12%, over 12%. And then when you print money, there are good reasons to print money. One of the reasons is that, there is a massive increase in productivity in our economy. So print money to match those increases. There's more output, you print money to match those. Or secondly, somebody has injected $30 billion into our economy, so they need the naira to be able to do whatever it is they wanted to do. CBN takes that money, puts it in the reserve, and then print the naira to give them to do what they want. These are some of the cases when they have to. But we went with government demand to print ways and means to print 30-something trillion. And so when you are doing that, what you are saying to the economy is this: a lot of money, but chasing fewer goods. That is inflation. Now, CBN will target that. And that is what it's trying to do. And that is the much that it can do. It has other tools, but it has much to do. But it increased the CRR, which is called the cash reserve ratio of the banks, from 45 to 50%. What that means is that if you go and deposit 10 naira now in a bank, 5 naira of it will go to cash reserve ratio, so they can sanitize it and then manage it. So and also don't forget that banks are capitalizing right now. So trillions of naira are leaving you to take positions in those their equities that they are selling. So again, some of that liquidity will be coming out of the system. So that's what the central bank keeps doing. But there are other reasons. If you look at ECOWAS, we have what we have 10 macroeconomic convergence criteria. One of them is you must operate positive real interest rate. Now, we have been on negative, in fact, minus 11%. So our rate, monetary policy rate is 27.25. But the inflation is 30 something, 37. So you could see that there's a gap. So we're in negative. So there is a tendency for CBN to continue to increase that rate while pushing down the inflation to a point when they are comfortable. But secondly, though, while they are doing that, it sends a signal to foreign portfolio investment, please come in. And some of them are coming in because they are coming in to target that high interest rate. But they won't come if the other conditions are not met. If the forex is not stable and inflation is jumping up, they won't come because they will buy today. Then by the time they receive their money back in 6 months, it has lost value.
Professor Ken Ife.
So there is that thing to juggle with.
Okay, Professor Ken Ife, development economist, speaking, to the recent decision by the MPC increasing the interest rate, that is the interest rate by 50 basis points to 27.25%. A lot more still to come, but let's take a look at some excerpts from that meeting. Let's listen to Dr. Chiamaka Enendu addressing the press at the close of that meeting.
Members assessed the performance of key financial soundness indicators and noted with satisfaction that despite familiar headwinds, the banking industry remains safe, sound, and stable. The committee, however, emphasized the need to sustain supervisory oversight on the industry to strengthen its continued support to the economy. Following these considerations, members deliberated on the optimal policy option to sustain the downward in price development, contain emergent risks to inflation, stabilize the exchange rate, and safeguard the banking system, while also shielding the recovery of output growth. The upside risks remained flooding, hike in energy prices, scarcity of PMS, and most importantly, security in farming communities. Considering the weight of food in the CPI basket, members recognize the efforts of the federal government in addressing insecurity in the farming communities and stress the need to remain steadfast. In addition, the MPC applauded the ongoing efforts of the federal government of Nigeria to bridge the supply deficit through duty-free import window for food commodities. Investments into the economy, efforts must be sustained to achieve a positive real interest rate. This would enhance the economy's competitiveness for international capital, thereby improving the exchange rate.
And you're still watching Business Daily, coming to you live on Trust TV. And just before the break, we started a conversation where we are looking, at the implications of the CBN's hawkish stance, looking at, the CBN's decision to further raise interest rate by 50 basis points to 27.25%. And I still have my guest here with me, who is a development economist in the person of Professor Ken Ife. Thank you, Prof, again for coming on the program today.
Thank you.
Prof, you made some very interesting points before the break. You talked about, the direction that we have seen global markets take recently. We have seen, rate cuts come from the United States, and I believe China as well, and some other major markets, taking a certain direction. But then it looks as though Nigeria is, do I see, an outlier? You've talked to, the reasons why that is the case. But I'd like for you to, further explain or juxtapose why you think that the CBN is taking a different path compared to these other major markets across the world.
Yeah, what I was saying, that we are not actually comparing like to like. Number one, Nigeria is an import-dependent economy. And what that means is anything goes, which means you are completely at the mercy of global headwinds. It doesn't have to be oil price alone that comes down that affects you. It doesn't have to be production volume alone that goes down and hurts you. It doesn't have to be. In fact, why are we being affected by Russia-Ukraine crisis? We have oil, they have oil. We have gas, they have gas. But because we are an import-dependent economy, the prices have gone up phenomenally in Europe that import 40% of their gas from Russia. So when Russia started turning down the tap, their prices went through the roof. And we are importing from them, so we have imported inflation. So anything can happen. You have COVID-19, it didn't start in Nigeria, but we were heavily affected because all the supply chain disruptions affected Nigeria. It's because our economy is hopelessly dependent on import. Even the things you're supposed to import, pharmaceuticals, you give them the raw material, they refuse to give you the finished product because they were protecting their own economy first. So all of that means you have enormous pressure on your foreign exchange. And bear in mind that 90% of our foreign exchange comes from oil, from crude. Crude 79%, gas 11%. So anything that happens in those two affects us, let alone the other 10%. So in that case, so then also when you, apart from the fact that where our economy is totally out of sync with what the other ones, we also have the fact that our economy is so subjected to forces, structural forces, that those other economies don't experience at all. Which of them is experiencing conflict that is affecting their production systems and even their oil and crude and all that? None of them. Our own is in every. We have separatism in Southeast. We have different ones. We have Boko Haram on the Northeast. We have banditry in North Central and Northwest. You have the armed conflict in the Lebanon. So all of them, different kinds of conflicts are affecting every region, and they're all impeding food supply and overwhelming our food supply production system. Then you have flood coming in and affecting us badly. You have 1 month of drought, no rain. 1 month. I traveled to Southeast and South to look at 3,000 hectares. All their maize dead, all the legumes dead, only cassava survived. So you have all of that. Then come and look at the electricity, which is the driver of industrial productivity. They hiked it by over 100%. You look at diesel is over 1,000. Then you have petrol even gone up. So all of those are affecting the transport costs. And then, so the whole thing, there are many of the long list. Those other economies don't have those kind of thing that are putting a lot of pressure. Then you have the worst of all of it, where you have excess money in circulation. What is the meaning of inflation? That you printed over 30 trillion naira that has nothing to do with productivity. It means that you only produce 100 million tons of food. We brought in 30 trillion more to buy the same number of food. And that food is going down because of the factors I've just mentioned, insecurity. So you have created more money going for some smaller and smaller dwindling volume of food. It's inflation. That's the meaning of inflation. And the CBN says, we're going to do something about that excess supply because it's in the domestic economy. So they began to apply policy tools at their disposal to try and do something about it. And that's what is uncomfortable to some constituencies, especially the manufacturing sector. But there are more trouble for the manufacturing sector than that interest rate. After all, the citizens on the street, they are not borrowing money from the bank. Their problem is that the things that they buy, there are too many taxes on them. So you now see the new fiscal policy now, if they implement it to say remove the VAT, remove any form of tax on food, electricity, utilities, water, health, education. Remove them because they are actually hitting the person who is on the ground. That's fine. It is the businesses that worry about that. But they're only worrying about that. The business that worry about are those who have to go for overdraft or to borrow. But for the corporate community that are in the capital market, they are getting their investment from the capital market. It's only the segment of their liquidity, their inventory, that they are overdraft that they may be wanting from the bank. So it's a smaller territory, but nevertheless important. So, but for those of those, fiscal policy is coming to meet them now, because fiscal policy says, okay, over 90% of this number of businesses, 42 million, are actually MSMEs. Increase the threshold. Instead of exposing them to tax things at 25 million, raise it to 50 million naira. That's good. That is good, because you are now relieving them of that pressure. And government says, okay, there are 60 tax. What the hell is going on? 60 different tax. All right, but the only 6 of them gives government 95% of the revenue. So what do you do with 55, 54? Remove them. Government is doing that. And all that are burden to the private sector. Far more burden to them than what we are talking about, increase of 0.5% is more burden. And so what I'm saying is that fiscal authorities are upping their game right now with sweeping reforms. But I'll just say, can they actually deliver those? Will they deliver them? But they are complementary. Yes. They are complementary to what central bank has been trying to do. Because I've just enumerated to you the structural factors that are inhibiting and making it so difficult for businesses to breathe in this country.
But from what you're saying, are you in any way saying that a major bulk of the responsibility, to ease the burden that MSMEs are currently going through lies on the side of the fiscal?
Yes, correct.
Okay.
That's where if you put percentages, it's like 80% is on the fiscal side. Okay, even the fiscal side, even the import duties, all that stuff is fiscal. Collecting revenue from NNPC and all this is fiscal, because when they get their money, they're borrowing money from outside, borrowing from international banks and all that stuff is fiscal. They're the ones borrowing the money, and then the interest that we have to pay is all comes back to inflationary pressure, and then the people pay inflation tax, for money that they didn't borrow. Because if you didn't print those 30 trillion ways and means, the people wouldn't have been paying inflation tax for the money that they didn't borrow. They didn't borrow that money. The government borrowed the money, and the people are suffering for it.
I would like for us to touch on inflation, which I like to call the elephant in the room, because this has been, one of the major focuses of the Monetary Policy Committee. But I would like for you to explain, especially for the benefit of our viewers who are wondering, how effective a rise or an increase in the MPR will, help to curb core inflation. Already we have started to see an easing in the past month, according to data from the MBS. But can you break this down in layman terms?
There are 5 components of inflation. First of all, let's deal with what is inflation and why is it important. Inflation is when more money is chasing fewer goods. In other words, your productivity is not in sync with the amount of money in circulation. So there are more money facing smaller goods. So the way you fight it is to increase productivity substantially to address that shortfall. And then, of course, you also have other ways of bringing in more dollar into the system and all of that. Okay, or doing more exports to bring in more dollar revenue. Now, inflation is so critical. It's the toughest single macroeconomic parameter that drives tens of millions of people into abject poverty. So it must be addressed. There's no point increasing salaries and all that when they cannot buy anything with the money. So you have to address it. And incidentally, it is the core mandate of central bank. So if anybody does anything, they are judged based on that. If the inflation is high, nobody says, "Oh, Minister of Finance, what have you done?" Everyone says, "Where's central bank? What have you done?" So that is their core mandate. And then when you look at inflation figures that you are seeing, like the ones of a few days ago, there are 5 components of inflation. You have headline inflation, you have food basket sub-index, you have core inflation, urban inflation, and rural inflation. All of them slowed down, but the core inflation went up. And it went up in the last month, it went up this month. So core inflation is where you have all the inflation indices minus farm gate prices of food, farm gate, and then imported processed food. Those 2, and also volatile energy costs. Okay, those are the ones they excluded in it. But the core represents everything, and is rising. So how can you say inflation is falling in the way it's being described? The core is going up. Let me tell you why it's going up. If you come to food inflation and core inflation, they have one component that is common to 2 of them. It's called imported processed food. import of food is still increasing, and the prices of those imported goods are also increasing. And that's also one of the reasons you see the dollar naira rate still keeps popping up and popping up and popping up. Now, it is in both of them. In the food sub-basket index, the fall in the prices of commodities, farm gate commodities, superseded the rise in the price of imported processed food. So that's why you saw it coming down. But in the core, it's still up. It's pushing it up because it's in there. So that's what a lot of people didn't appreciate. That's why it's going up. So you still have to keep fighting it. Now let's look at what is going to happen to food inflation, which you saw coming down. How down can it come? Is big question. Now government is going to give duty free for 6 months for food to come in. Food will come in. There's no guarantee that those importing it will pass through the low cost, because they know they can hold it, they can increase it. They still decide to pass it to the consumers. But be it as it may, there is a demand for forex. They're going to import, they're going to go to central bank for forex. Forex that you don't have. So there's going to be a higher demand on forex, and forex goes up because of the demand, which means it will probably even cancel the benefit you would have had in the drop in the prices of the goods by removing the duty. They may tend to cancel out. Second point, you have flood. Now, flood means lower yield. Many of the fields, you can't access them again, food shortage. Then you have 1 month of drought in early August, late July. That is already coming because the crops died. And then they're going to have infant food. So you have other things counterbalancing. Then you are heading into we are in the ember month. Ember month means you are heading to December, prices go up. So in the inflation cycle, that's where you peak in inflation, because people are bringing all the money they've been saving to kill cows and then buy more food than they require to stock up. The prices are going to go up to respond to that. So what you are seeing as dropping inflation is going to be in a food inflation may also be forced to go up or don't go down as much as you can. But look, it is not that the prices are actually going down as such, because when you look at inflation compared to 12 times last year, 12 months last year, it is up.
That's the year on year.
Yes, year on year is up. But month on month is moderating. But it's still high. It's still going up, but it is, the rate of change is what is, it is still up. The rate of change is what is coming down.
Prof, I would like to hear your thoughts on micro, small and medium enterprises while we await reforms from the fiscal side of government, like you rightly pointed out. I mean, this is the case now, an increase in interest rate, and MSMEs already had been, clamoring for, a better business environment to thrive and to survive. But unfortunately, we have yet another increase. I would like to hear your thoughts on the broader implications of this, especially in the commerce, trade, and investment industry here in Nigeria.
You know that one of the tools that the central bank has, in fact, when you look at mandates, the core mandate of every bank in the world is price stability. There are other mandates like financial system stability, which is also one of our own. Then in America, they have employment. Remember, they report on employment every month as they report on, so they are concerned with that. But there is also a secondary mandate across all commercial central banks, which is to promote sustainable economic development. So in the last regime and other regimes, they saw the threat to our market of market failures. So that was why you saw them intervening in the domestic finance intervention to say, okay, since this sector, manufacturing sector, MSMEs are struggling with this, and there's market failure in access to finance in agriculture, then let us put money here, put money there, and you had those massive intervention. Up to 8 trillion naira was out there, supporting these businesses. This bank, this particular administration said we're not going to go down that route. And so they're taking the backseat, walking away from that. That was one way of helping the businesses, but now it is coming out of it, that they will find other ways. And there are other ways that could be used. For example, on the first day the president was sworn in, he said, I want to do in credit. He was looking at credit creation, And then I had wanted to see that will also be used to target manufacturers. So that if you are buying anything, instead of cash economy, you have to have 100% of the money to buy anything. If you want to buy a car, just go and put 10% down and drive away with the car, and then you'll be paying over 3 years. So that will be in credit if that thing was done as I thought that it was going to be done for over a year now. But it's something that could help cushion the effect of withdrawal of domestic finance intervention. But there are many other things. So more help had to come from the fiscal side, because the fiscal side carries a lot more weight in the things that are weighing down the businesses. It's not just money, because after all, if you have enough money to start your business and you are running it and you don't have to borrow money from the bank, which one will be your business? Your business will be inflation. You know, that you can't afford this thing, your raw material and all that. So it's not every MSME, small ones that actually run to borrow from the bank. I've mentioned that before. So it's not all of them. But the fiscal are coming in to deal with the things that they face day every day. But the ones that are borrowing, and they won't forget again, that the central bank targets the banking sector. Because it's the banking sector that creates that credit. So they keep targeting them. That's why they're raising their CRR rate to suck away some of the money. And that's why that's part of the reason why go and capitalize, suck out more money from more trillions, some amount. But as you are bringing it, they're taking some of them and sanitizing them.
As cash reserve.
Sanitizing them, yeah. And then don't forget that there was a time they were also worried about forex stability from the perspective of supply. And then they went to the banks and said, oh, look, you guys have over $5 billion stored everywhere. You know, we want some of that money. Don't keep anything outside 20% of your net open position. So any money that they're trading, and when they have credits that are outstanding, the banks, they're issuing a lot of credit. They're already giving you credit. And so they have to hold the dollars to be able to fulfill their obligation. He said no more than 20% of that your stock of dollar should be kept. Sell them. But CBN should have told them, oh, sell that money to me. But he didn't. He said, sell them. So they sold it to whoever they wanted to sell it. Obviously, they all have groups of companies and all of that. So that was to tell you how the CBN has been going around trying to plug some of those holes. Now, the biggest thing that CBN has actually done to help this inflation is to come to the forex, because of the latitude of inflated inflation, to come to forex and then close that gap between the official rates and the black market rates. Close that gap and held it closed. And what you have done is that you've removed the arbitrage opportunity, because the arbitrage is the difference between the two. So you can buy money
rate
here
and the BDC.
And sell. Yeah, so when you buy and sell, you arbitrage. So that keeps on. But then you also have the massive stock of dollar in the country, which is called dollarization of our economy. And that dollar is also trading on the spread. So the spread window is closed. So they can't trade now. They only be forced to bring out their money and sell it to anybody they want to sell. But it's no longer for the purpose of arbitrage. You know what I mean? And then when this bank gets stronger by the Dangote refinery thing helping us and removing 40% of forex, or even CBN say 15%, and then when you now have more small output, then what will happen is that the CBN will don't forget that our reserves have gone up by over almost 9 billion to 49, something like that. It's gone very, very high now. Now, when those monies begin to come in, those savings, what you will now see, those 1560 or 1,600 naira to a dollar will begin to come down. And as it is coming down, because the two rates are aligned, as it is coming down, those massive stock of dollar in the country will start panicking. Because you don't want to keep dollar that is losing value. They will start panicking and they will start selling. So then they will start picking them up. So you know what I mean? So they know what they're doing. They are gradually getting to it, but this economy is a very tough economy. So that's why the fight is so prolonged. But we'll get there. We'll
get there. Fingers crossed, like you have rightly stated, Prof. Hopefully we start to see, the effects of this mop-up by the CBN in the short term. But I would like to hear, your future outlook. I mean, do you expect to see the CBN continue to maintain the hawkish stance that it has maintained for quite a while now? Or do you expect to see a policy reversal in the coming months?
I don't even think so. You know what? The next meeting they will have, obviously before Christmas, we will need to see how much some of the dynamics of flood and draft and all that we would like to see, and then the import removal, duty removal. We need to see how it affects food supply in real terms, because that will also show the extent to which the inflation will drop. So we want to see the two inflation figures next month and the upper month. But if they are having a meeting, if nothing significant has changed, they will still increase this rate. I'm telling you. It may not be 50 basis points, maybe 25 basis points. It's not until, and don't forget that inflation automatically comes highest in December, November, December. So they will need to watch, because the last thing you will do, drop it today, and tomorrow you are forced to jump even 1 point something percent.
Even further.
Yes, further. So they would watch. They will watch to see the impact. So, seriously, I expect a rise next month, but maybe not as steep as this, maybe 25 basis points. But in January, then we would have soaked in the impact of all of those, and they may have crossed the natural cyclical peak of inflation, and now say, okay, we are going to deal with a different type of inflation, which is because from then, as they are heading to March, people will begin to plant their things, and so they made this thing to let's hold to June to now see what happens. That's what I think.
That's a long-term plan from your own perspective. Thank you very much, Prof, for all the insights you've shared with us today, and obviously for breaking down, what it means, what inflation means, and what the decision of the CBN from yesterday's monetary policy meeting meant. Thank you again, Prof, for coming on the program today.
Thank you for having me.
Professor Ken Ife, who is a development economist, speaking extensively to the decision of the Central Bank of Nigeria, which the committee voted to raise interest rate by 50 basis points to 27.25%. But this is where we draw the curtains on today's edition of Business Daily. We'll continue the conversation with us on social media. Let us hear from you. What are your thoughts on the decision of the CBN Monetary Policy Committee? Are you for or against? Share your thoughts with us on Twitter, on Facebook, on Instagram, and of course across all major social media platforms, including YouTube. My name is Chiamaka Enendu. Thank you for watching, and bye for now.